The revenue recognition principle entitles that revenue should be recorded when a resource has been earned, not when you receive the cash. This means that revenues or income should be recognized when the services or goods are provided to customers regardless of when the payment takes place. This is because income statements will show more profits than they earned in that period. However, in the future, it will have the opposite effect because the revenue which were previously recorded too early will now be missing from the future periods and cause those financial statements to have less profits. An example of the revenue recognition principle is a painter being paid to paint someone's wall. The painter receives $5,000 to paint the wall on the 7th of November, 2 weeks prior to actually being booked in to perform the job. The painter must debit the cash account of $5,000 while crediting the liability account of unearned revenue $5,000 also on the 7th. However, once the role has been performed on the 21st, the painter must update his accounts by debiting the unearned revenue account $5,000 because the revenue has been earned and crediting the service revenue account $5,000. An example of businesses using unearned revenue all the time is if the business requires a payment before they provide the good or service to ensure they receive payment and the consumer doesn't just not pay them. Examples of this is booking a plane flight or a concert ticket. You must pay for the service before the service has been performed. This reduces the financial risk of the consumer not paying after receiving the good or service, as the company performing the service has already been paid. However, if the service isn't upheld, a full refund must be paid to the customer. Revenue recognition is a part of the accrual accounting where revenues and expenses are recorded when they are incurred, regardless of when the cash is paid or received. This is different to the cash method of accounting, where revenues and expenses are recorded when cash goes out or cash comes in. There are pros and cons for each, but it mostly depends on the type of business you're running, whether it be a small business mainly dealing with cash or a large corporation selling mostly on credit. A common issue that people don't understand with the revenue recognition principle is if the job, for example, painting the wall, takes place over an entire week. When is that revenue recognized in the income statement? Well, a percentage of completion must be estimated, which is then multiplied by the expected revenue gained from the project, in this case of the painters earning $5,000. If he completes 1/5 of the project each day, he will multiply that by the $5,000 he will receive to get a service revenue of $1,000 per day. However, on larger projects which span months, even years, it is much more difficult to estimate the service revenue due to subsidiary factors like delays in the project, days where the project can't be attempted due to inclement weather. The revenue recognition principle, a key aspect of accrual basis of accounting, is a concept students struggle with because of the complicated processes that can be involved when estimating how much revenue has been earned. However, the basic idea behind revenue recognition is that revenues are recorded when earned and expenses are recorded when they are incurred.